protective put. Now, a protective put is when you combine a long put option against at least 100 shares of stock in an attempt to completely reduce or eliminate the risk of a long stock position below a certain price. So let's get into it. Alright, so the protective put is also sometimes called a married put, but this is a strategy that consists of buying a put option against 100 shares of long stock. Now, this strategy is used to cap the downside risk of a long stock position through the purchase of a put. Now, the way it works is that when you buy a put, you have the ability to sell 100 shares of stock at the put's strike price. So if you own 100 shares of stock and you buy a put against those shares, you effectively lock in a maximum loss equal to the strike price of the put, because the worst case scenario, if the stock price goes to zero, you'll be able to sell your shares at the strike price of the put you purchased. However, you'll have to pay a premium for that risk reduction. So let's get into the strategy characteristics of the protective put. So the maximum profit potential is unlimited because you own 100 shares of stock and there's no limit to how high the stock can go. Now, the maximum loss potential is the difference between the stock purchase price and the put strike price. So remember, when you buy the put, you can sell your shares at the put strike price in the worst case scenario. So the maximum loss on your shares is the difference between the price you pay for the shares, the put strike price, and then you have to add the debit you pay for the put because you're paying a premium for the put option, and that is included in your maximum loss as well. And then you multiply both of those things by 100 to get your maximum loss potential. Now, the expiration break-even price is the stock purchase price plus the debit paid for the put. So one of the bad things about the protective put strategy is that since you're paying a premium for that downside protection, you're actually increasing the break-even price of your long stock position. So now you actually need the stock price to increase just to break even, whereas if you just buy a share of stock, you just need it to increase from its current level and you'll be profitable right off the bat. So when you buy a protective put, you're actually increasing your break-even price, which means you need the stock price to increase just to break even on the strategy. Now, the estimated probability of profit of a protective put is less than 50%, and that's for the reason we just discussed. Since the cost of the put increases the break-even price of your long shares, you need the shares to increase in price just to break even, and therefore you have a less than 50% chance of making money on this strategy. Now, after expiration, if your long put is in the money, the long put will automatically be exercised and you'll effectively sell your shares at the strike price of the put. Now, if the long put is out of the money, then the put will expire worthless. You'll lose the premium you paid for the put, but you'll keep your long shares. Now, in regards to assignment risk, the protective put strategies does not include any short option positions, so there is no assignment risk. So now that you know the characteristics of the protective put strategy, let's go ahead and look at an example. So here we see we have an option chain and we have call prices and put prices. So we're going to construct a protective put from these options. So in this case, let's assume the stock price is trading right around $150 and we want to buy stock, but we don't want all the downside risk. So we're going to buy 100 shares of stock for $150 per share, and then we're going to purchase the 145 put against those shares, and we're going to pay a $5 premium for that 145 put. So we purchase 100 shares of stock for $150, we buy the 145 put, we pay a $5 premium for the put, which brings our break-even price to $150 plus the $5 premium that we paid for the put, which brings our break-even price to $155. So at expiration, the stock price needs to be above $155 for us to break even or make any money. So let's take a look at the expiration risk profile graph for this protective put position. Alright, so let's go ahead and start with the red line here, which is the stock purchase price. So we're looking at the long put strike price in relation to the stock purchase price in relation to the break-even price. And along all of these different stock prices at expiration, we can see the profit or loss of this particular protective put position. So right off the bat, we notice that we bought shares of stock for $150 per share. And if you notice, at expiration, if the stock price is at $150 per share, we're actually going to be in the hole by $500. We're going to have a $500 loss, even though the stock price did not change. Now that's because we paid a $5 premium for the 145 put. And if the stock price remains at 150, the 145 put will expire worthless and we'll lose the $5 premium we paid for the put. Now, of course, in real dollar terms, a $5 premium on an option is $500. So if the stock price remains at 150, we will lose $500. Now, however, if the stock price falls to 145, our maximum loss is $1,000 because we'll have a $5 loss per share and we'll have a $5 loss on the 145 put that we purchased. So the net loss in that case is $1,000. Now if the stock price goes to 120, our loss is still $1,000. That's because we're going to have a $30 loss per share since we purchased them for 150 and now they're worth 120. So we have a $30 loss per share, but that 145 put is going to be worth $25. And since we paid $5 for that put, we have a $20 profit on the 145 put. So if we take the $30 loss on the shares minus the $20 profit on the put, we get to a net loss of $10 per share or $1,000 overall on a 100 share position. Now if the stock price goes to $170, we'll have a profit of $1,500. Now that's because we'll have a $20 profit on our long shares since we purchased them for $150, but we'll have a $5 loss on the 145 put that we purchased because if the stock price goes to 170, the 145 put we purchased will expire worthless. So if the stock price is at 170, we'll have a $20 profit on the shares minus the $5 loss on the put, which brings our net profit per share to $15. If we multiply that by 100, we get to $1,500. So now that you know the characteristics of the protective put and you've seen what the expiration risk profile graph looks like, let's go ahead and take a look at some protective put trade examples to show you how the strategy might perform over time as the stock price increases, decreases, or remains flat. So the first example we're going to look at is a protective put position that ends up profitable. So here's the setup. The initial stock purchase price is $77.21, and we're going to look at buying the 77.5 put that expires in 74 days. For that put, we're going to pay a $4.95 premium, which brings our break-even price to $77.21 plus $4.95, which is $82.16. So the share purchase price plus the cost of the put comes out to $82.16, so that's where we need the stock to increase to break even. The maximum profit potential is unlimited, and the maximum loss potential is the share purchase price of $77.21 less the put strike price of $77.5 plus the premium paid for the put of $4.95 times 100, which brings us a maximum loss of $466. So let's go ahead and take a look at how this position performed over time. Alright, so in the top of this graph, we're looking at the changes in the stock price, which is the dark line, and we're looking at the long put strike price and the break-even price of this protective put position. Now in the bottom part of the graph, we're showing you the profit and loss of the married put or the protective put components so that you can understand where the position's performance comes from. So as we can see here, the stock price starts right around 77.5, and through expiration, it actually rallies to a point that is above our break-even price of $82.16. So right off the bat, we know that the strategy will be profitable because the stock price is above our break-even price. Now let's go ahead and look at the profit and loss of the components. So we can see that the blue line represents the profit and loss of just the long stock position of 100 shares. The yellow line is the profit and loss of the long put that we purchased with a strike price of $77.5. And the green line is the combination of those two things. So the green line is the protective put, which combines the long stock and the long put. So in this example, we can see that the long stock position actually performed the best. Now that's going to be the case in every protective put scenario where the stock price increases because since you paid a premium for that put as protection, you are going to create a drag on the profit and loss of your long stock. So if If you buy protection against your shares and the shares increase, you're going to make less money than if you did not buy protection at all. That's just our classic risk-reward scenario. So in this case, the long stock position ended up with profits greater than $600, but since we paid a premium for that put option, the married put position only had a profit of around $200. So here we can see that the married put position did not do as well as the long stock position because the stock price did not collapse. So this just shows that when you put on a protective put, you are giving up some upside in the stock because you're paying a premium for the put that you purchased for protection. So let's go ahead and take a look at another example. So in this next example, we're going to look at where a protective put really shines, which is when the stock price is just collapsing. So here is the setup. The initial stock purchase price is $254.53, and we're going to look at buying the $245 put that expires in 37 days. Now for that put, we're going to pay a premium of $14.15, which brings our break-even price on the strategy to the share purchase price of $254.53 plus the put cost of $14.15, which brings our break-even price to $268.68. So the stock price has to rise to $268.68 if we want to break even on this strategy. Now the maximum profit potential is unlimited, and the maximum loss potential is the difference between the share purchase price and the put strike price. So $254.53 minus $245, and we're going to add the put premium of $14.15 to that, multiply it by 100, and we get our maximum loss of $2,368. So let's go ahead and take a look at how this protective put position performed through time. Alright, so again, in the top part of this graph, we're looking at the changes in the stock price relative to the long put strike price that we purchased and the break-even price of this protective put position. Now again, on the bottom part of the graph, we're looking at the profit and loss of the protective put components. So the blue line is the long stock profits and losses, the yellow line is the profits and losses of the long put, and the green line is the combination of those two, which make up our protective put position. So on the top part of the graph here, we can see that the stock price kind of remains flat for a little bit, and then it just completely collapses down to around $200, so it drops nearly 20%. So as we can see here, if we look at the profit and loss of the protective put components, the long stock position lost a considerable amount of money, but to offset that, we can see that the long put actually started increasing in value and was creating profits for us. So this really just shows how a protective put works. Since a protective put, or when you buy a put option, that is a negative delta strategy, which means it profits when the stock price goes down. And when you own shares of stock, that's a positive delta strategy, which makes money when the stock price goes up and loses money when the stock price goes down. So when the stock price goes down, your long stock position is going to lose money, but the protective put that you purchased is going to make money. So in this case, we're looking at the comparison between the profits and losses of the long stock position and the married put. So as we can see here, since that put option is increasing in value, that is offsetting the losses on the long stock position and makes the protective put's profit and loss less severe than just long stock alone. So at the worst case scenario here, the long stock position was down about $5,000, but our married put position was only down around $2,300. So this just shows you that if the stock price really falls, owning that protective put is going to be extremely beneficial because it's going to limit your downside risk. Alright, so that pretty much sums up everything you need to know about the protective put strategy. So let's go ahead and summarize the main concepts that you've learned from this video. So first of all, a protective put consists of buying a put option against 100 shares of long stock. Now, a protective put caps the loss on the long shares, but increases the break-even price of the position, and as a result, that lowers your probability of making money on the trade. Now, to close a protective put position, you can sell the long shares and the long put at their market prices to lock in any profits or losses on the strategy. So you do not need to hold a position to expiration. Now, if the long put is in the money at expiration, the trader will lose their long stock position because a long put expires to negative 100 shares of stock. So if you let the long put expire in the money, you'll effectively sell your shares of stock at the put's strike price, realizing the maximum loss for the strategy.